into the picture over the intermediate term, let's say. I'm not going to go into the other stuff, but I put some more graphs in there that you can take a look at on your own time in terms of gold and other commodities. Commodities got hurt again a little bit today, somewhat in line with gold and with oil. I've got some oil graphs in here. Let me have you turn to page 50, if you would, on the US dollar. We had a big move up today in the dollar. Dollar jumped to 81.90, which you don't see on this graph because this had to be printed. So it's up to 81.90, and there's an interesting thought. Prechter, again, has been talking over much of the past decade about what he calls an all-the-same market pattern. Asset prices have been rising roughly in unison, and the declines have been roughly in unison as well. You got stocks, you got gold, you got other commodities, you got real estate, and so on. They were all rising when liquidity was being pushed into the market. The dollar was working in the opposite direction. So the dollar was the opposite. Now we've seen the dollar start to rally over the last few months. And I think there are some fairly knowledgeable folks that are concerned that if the dollar continues to rise, and there are all sorts of good fundamental reasons to say the dollar should not rise, but the dollar is rising. That may or may not continue, but it could be dangerous for other asset prices if the dollar continues to rise. Today, there are other things. If you look on this graph, for example, you see, first of all, there's a very good divergence. When the price was going down here, you saw the momentum rising. Interesting divergence there, which did accurately foretell a coming dollar rally, which we've seen here. Now, though the momentum has risen, it hasn't risen very enthusiastically. And so now, with this having gone up to here, the burden is on this to start rising. If it doesn't, we'll know in the next few days, weeks, month, or whatever, then maybe that's the end of at least this leg of the dollar rally. And that would probably be a good thing for other asset categories. Conversely, if the dollar continues to rise, it could be a bad thing for some of those other asset categories. And I won't get into the carry trade, which is a whole different matter, but that could, when you got a zero interest rate, a lot of people borrow cheap currencies and invest them in assets in other countries. And if the dollar or other cheap currency, which has historically been the yen over the last many years, if that starts to move, then all of a sudden people have to go back in and pay off their yen loans or their dollar loans, which pushes that currency higher, and it pushes other assets lower as they have to sell those assets. So currencies can be a director in the moves that we might see. Let me turn your attention to the last page, 53. I'm going to wrap it up in a couple of minutes and answer, just give a little concluding few thoughts here. Modern investors still love stocks. I'm coming back to stocks because the bulk of this was really aimed towards stocks. This graph provides a valuable long-term perspective on valuations and market risks. It is a ratio of stock market capitalization as a percentage of the gross domestic product going all the way from the 20s to present. What it shows is how much the ownership of all stocks, how much value existed in stocks, dollar-wise, relative to the size of the economy at that time. And you can see that the ratio goes up and down and up and down. As you could well expect, people are most enthusiastic about stock ownership when stocks have been rallying. That's the history. People, when markets go down, they don't want to own stocks, they step away from them. That's the history. This was 1929, this was 42, and then we have the 60s and 70s in here, and so on, and then the decline into the 80s, and then of course we went parabolic in the mid-90s, and we've never come off that love of stock. We got temporarily up and down lower, But we've stayed in a very, very high zone of loving stock, and we see it in terms of the percentage of the amount of stock relative to the size of the economy. All this says, historically, the investor's been dead wrong. Wanted stock, and it had a huge amount of it at market tops, had a minimal amount of it at market bottoms. Obviously, should have been the other way around. Now, we don't know if it's different this time, if all this love of stock is going to become permanent. People on this graph have tried to draw a regression line through here and say, maybe, maybe we're going to a whole new level. But if they had drawn it at a different time, say they drew it when the thing was down here, the regression line would have looked like that. So we don't know. All we know is that on a historic basis, people love stocks a lot more today than they historically have through long cycles. We've been saying for 12 or 13 years that we've been in a dangerous environment for stocks. Clearly, the last decade has showed that it was a dangerous environment for stocks. Danger doesn't mean something bad is going to happen. It means something bad might happen. That's the concept of danger. It isn't sure. It could happen. This is a probability business. It's not a certainty business. And I would argue we are in a very dangerous environment still. We look around. We know that we now have the greatest debt in the history of the world. We don't know how it's going to get paid off. We don't know. Neither does the Federal Reserve. We don't know those things. So we're going to have to wait to see how it evolves. But clearly it's a danger. Economies are running, they've come off the bottom. We're seeing good statistical growth, but we're still at very low levels on most economic readings. And we don't know, we can't know, how the markets are going to react when the stimulus is first stopped and then secondly withdrawn. We don't know. We've never done it before this way. So it's an open question, which is one of the reasons we would say it's a great danger. Now that doesn't mean it can't be resolved positively. It might be resolved positively. Maybe the government officials in Treasury and the central banks of the world, who by the way are the people who largely were presiding over the crisis and before the crisis, so they didn't see it coming. But maybe they've learned and they now have figured out a proper way to get us out of it. That may be. That might happen. But it might not. And that's the concept of it's still dangerous. And every individual or every organization has to evaluate for himself, herself, or itself whether, if the danger is resolved with a negative conclusion, can we withstand a substantial loss of assets? We don't know that that's going to be the outcome, but if we are in real danger still, that could be the outcome. So you have to then say, okay, even if, let's say it's an 80% chance it's not going to resolve really badly, but there's a 20% chance that it could resolve really badly. Could I withstand, if it's the 1 in 5, for example, could I withstand it given my life situation, my financial situation? And that answer is different from one person to the next. Right now, really safe returns are providing essentially zero. Government has done that deliberately. They're trying to force us to take risks and buy other assets. We've been unwilling to do this. In retrospect, it would have been brilliant to have taken the risks a year ago. Clearly, it's been a phenomenal period for assuming risk. In fact,